As of the time of recording, we've got 5 hours of declines on the oil markets, but up until earlier on this morning, on this Tuesday, the 6th of July, prices have been rising following the failure of the OPEC Plus meeting that was held at the back end of last week. Let's find out more now with oil and gas analyst Sam Wahab from SP Angel. Sam, good to talk to you. Thanks indeed for taking some time out to discuss this with us today. What's going on?
Yeah, Jeremy, it's been a bit of a tumultuous time in the oil markets. Clearly, it's been good for the bulls, and this has really stemmed from the OPEC Plus meeting, which took place on Thursday last week, and actually run into Friday. And subsequently, yesterday, they announced that they couldn't reach an agreement, and it was being called off. This time, the fractions have come between Saudi Arabia and the UAE. If we go back a little bit here, the UAE have invested quite heavily over the last year in their oil infrastructure. And the deal that was put on the table by Saudi Arabia and potentially Russia as well was to increase incrementally 2 million barrels of oil a day in 400,000 barrels of oil a day sections from August of this year to the end of the year. So that was agreed to by the UAE, but then they refused to agree with is actually extending production quotas all the way through to December next year. The existing deal was for that to cease in April 2022. So they decided that no, they weren't going to run with those particular production cuts. But Saudi Arabia said that they had to go hand in hand. So there was a bit of an impasse there, and it didn't seem that they were going to agree on this. And I think they were bringing in other sort of social and political issues to the table and making that public, which is quite rare in this group. And so they called that off. And so how we sit today is that potentially the 400,000 barrels of oil a day introduction of more barrels from the 1st of August will now not go ahead. So they'll stay at the current levels, which has led the oil price to increase quite significantly.
It's interesting, isn't it? You mentioned the fact that there are other factors at play here. I mean, the Middle East is a potential tinderbox that could go off at any time. I know there are lots of political interests there. Do you think that the exposed differences that have come through from this meeting between the UAE and that Saudi-Russian partnership that obviously now seems to be cemented at the top of the OPEC Plus tree, if you like, do you think that this is just a local brief spat that can easily be repaired, or do you think this is beginning to open up some fissures that could end up causing some real problems for OPEC and OPEC Plus?
Well, no, and that's a very interesting dynamic you just brought up there, Jeremy, especially going back to the Russian and Saudi Arabian influence last year, where they had an all-out war, and that led to a negative print in the WTI last spring. Where I think this is a bit different and also a little bit strange is that UAE is almost being sort of pushed out to the side. Their importance within the OPEC Plus dynamic is clearly not that as important as it was for Russia last year. Currently, they produce around 3.8 million barrels of oil a day. That's on the overall OPEC Plus output, that's much less. That's probably about a third of what Russia currently produces and a quarter of what Saudi Arabia currently produces. So I think they are very much the little brother in this argument, and that there is, the potential is here that they will enforce more quotas on them, and they might have to return to proceedings on that basis. Whereas the last oil price war between Russia and Saudi Arabia was much more important. Both produce at similar levels, and therefore they had to take each other with a lot more importance than they currently clearly appreciate the UAE.
Yeah, let's bring up a price, if we can, of Brent, because I know that OPEC benchmarks against the Brent price. Today, we have seen it peak up well in excess of $77 a barrel. We've got a pullback at the moment. Just explain what's going on here in terms of the dynamic. Why are prices rising out of this failure of this summit? I don't know what's happened in the last 3 or 4 hours. There's certainly no news headlines to indicate that the reason why there's this sell-off at the moment. But what is it about the rise that we've seen? What is it about the gains that we've seen since the failure of that meeting? And anything else that you can bring in terms of pricing on Brent at the moment?
Yeah, sure. Well, the important thing to note is here that the failure to agree any sort of quota cut from the 1st of August of this year means that no quota will be imposed at all. So it will stay at the July 2021 levels, which was, we saw a 450,000 production increase. So we were due to subsume around 400,000 barrels of oil a day in addition to that from the 1st of August. But as it stands today, given there was there was a failure to agree on that it stays at current quotas. So we don't, and if that extends even further, then the slated 2 million additional barrels per day to hit the market will also not be there. So it stays at current levels. Whereas if you look at the other end of the spectrum here, the issues with Western economies, especially now reopening post the pandemic, the demand and consumption levels will be that much higher going into the second half of this year, and yet the production levels will be remaining the same. To put that into numbers, the OPEC Plus reduced their overall output by 10 million barrels of oil a day during the pandemic. Since it started to reopen, OPEC Plus have only increased by 4.2 million barrels of oil a day. So with the predictions that there'll be an additional 5 million barrels of oil a day demand second half of this year, it shows you that, that the inventory capacity and inventory levels will be needed to be tapped into and could be severely drained, and the oil market completely tightened, which is why we've seen predictions following the failure of that meeting that oil could reach $90 per barrel Brent in quite short order.
That's an interesting level. If we go back to the chart, in fact, we can see actually today, and in fact the last few days, we've broken to these highs that we haven't seen in the market since back into 2018. And the last time we were at the $86 level was all the way back in October 2018. So if we break to 90, that takes us back to levels at multi-year highs. Realistically, is that possible, do you think? I mean, you've been talking there about some anecdotal third-party commentary. Do you think that's likely, or do you think at that point we'll see that the market's then flooded with, let's say, American oil? Because let's look at this, because from the US point of view, the oil rig count is creeping up, but I don't think the US is anything like back to the sort of levels of production we saw before the big turmoil in the markets last year.
Absolutely, and that's interesting you bring that up as well, Gary. The US, I mean, historically, every time there's been a run on the oil price, the US shale industry completely explodes, and you see the US Baker Hughes rig counts go through the roof. That's not happened this time, and I think that's partly, well, there's two reasons. Saudi Arabia seems to be fairly comfortable in pushing the oil price further, potentially increasing their market share, because they don't see the US shale industry increasing at historical rates. And the reasoning behind that is that the capital availability to the US shale drillers simply isn't there as it was back in the last three oil price cycles. The US banks and venture capitalists and PE firms are now requiring a return on capital, real value from their investment relative to just volume hitting the market. And that's been quite prominent during this particular run on the oil price. So, and the Saudi Arabia have been fairly vocal in sort of pronouncing the fact that they're not worried about the US shale industry at the minute. And let's not forget, the US still are producing at around 12 million barrels of oil a day. It's not completely gone away, but the financial backers of the US shale industry are requiring that much more. And that might be due as well to an explosion in some of the renewables areas of the subsection of the business, where there is optionality now for energy investors. And the US shale industry sees that. And so they now have to focus on investor returns rather than simply just production volumes.
One final question is, what's next year looking like? Because the oil industry has a very long views in terms of the investment and the pipeline preparers and the way they get the stuff out of the ground. It takes a long while to get oil onto the market. What is next year looking like now? Have we not had the exploration that we should have been having over the last year, which may end up with a lack of oil next year on the market? Or are you satisfied that the market's going to be well supplied?
Well, no, I think you're absolutely right. The exploration cut from the super majors and the independents from last year, they've taken a reduction of 5 years worth of capex in 1 year, which is extraordinary levels of or lack of investment. And similarly, if you look at the actual producing and development wells that are in place pre-pandemic, leaving them to sit idle or to turn off taps, it's not simply that easy just to switch them back on again. They can actually turn them into uncommercial wells because the cost of restarting old production could outweigh capturing even today's oil prices. In terms of where I see the oil market next year, we're in quite a strange dynamic as it sits today. Saudi Arabia are in a bit of they're caught between a rock and a hard place here. on one hand, they don't want to increase the production quotas and then a surprise element of this pandemic, because we're not out of the woods yet in terms of new variants coming into play and some sort of demand destruction taking place quite quickly, which we saw last year. So that there's still a little bit of trepidation from that point of view. But secondly, as well, on the other side is the inflationary impact that this will have on recovering economies. And as the oil price continues to tick up further, it will start to get more pronounced for recovering economies such as the UK that are looking now to unwind all of these restrictive measures that we have in place, look to travel around the world again. And if oil is that expensive on an inflationary level, then they'll look to seek out alternatives such as renewables, which weren't simply an option 5-10 years ago. If you look at inflation going back since the year 2000, so the last 20 odd years, on a real inflationary level basis, so if you strip out the inflation levels, it's only been above $80 per barrel around 60 to 65% of the time. And that includes when, 2013, 2012 levels where we were, $120 oil Brent. So on that basis, we will see a bit more of a crunch. Policymakers, businesses, just consumers, consuming industries and consuming countries will start to wise up to Saudi Arabia's manufactured oil price environment unless something can be agreed quite soon. So I wouldn't be surprised to see OPEC Plus return to the table before the end of this month to get a deal agreed. I mean, in one way, they don't have to do it physically anymore. These meetings take place virtually, so they can be done quite quickly. It's quite a fluid dynamic that they have at the moment, and I fully expect that to happen.
Really interesting. Look, we'll end it there, but thanks indeed for joining us, Sam. It's interesting to talk about what's been going on and the outlook for the oil price. Thanks for joining us. That's Sam Wahab. He is the oil and gas analyst at SP Angel. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.